Hey everybody, Chuck Barone. Monday, February the 27th, 2023, coming down to the end of the second month of the year, and it's finishing with a big flaming turd burger. Just the way this whole month has kind of gone. Interesting day today, a lot to talk about, guys, but before we start, as always, I want to welcome everybody to the show. Thank you guys for your support. What you guys do every day means the world to us. Markets today. Well, you guys saw the show on Friday. You know the market had a mighty jolt on Friday as the reality of this inflation, what's going to be necessary to tame this inflation, higher rates, higher for longer, more pain, highly likely a big recession coming. Market reacted Friday in a really terrible way. Today, rebounded surprisingly. I think the market just has so much extra cash sloshing around. People afraid to buy bonds now with rates going up. Metals not looking great with a strong dollar. Where do you go with your money? So I think the people want to be in this market, looking for a reason to rally it. And market comes up a little bit today, not anywhere near the declines of Friday, but the Dow gaining 72, S&P up 12, NASDAQ also gaining 72, and then not a bad day for the NASDAQ. This market, guys, let's face it, the trend is down, and the trend will be down. The reality of this inflation is what we've been telling you guys all along. I'm old as older dirt now, right? And I lived through the previous inflation. And I've been trying to warn you guys and tell you, the idea that the Fed's just going to raise this little bit and bring inflation down to 2% was a pipe dream the whole time. You guys will remember me saying, to get inflation down, the interest rate needs to be higher than the rate of inflation. Not yet. Not there yet, okay? So as the Fed continues to raise rates, they're going to continue to raise rates. I would not be in any way shocked to see further surprises on CPI, on PCE, even the PPI, with continuing pressure on prices rising. This market's going to be tough, guys. The advice we've been giving you still goes. Invest very defensively. Look for high dividend stocks, stuff that people are going to use no matter what the economy looks like. Food, soap, medical care, defense, all these high dividend stocks, consumer non-durables, and preferred stocks. There's a lot of opportunity out there to get yield, guys. And that's what we're looking for right now, because I just don't see big gains coming in this stock market this year. Bond market today, yields falling, prices up today. People buying bonds, go figure. The 10-year down 3 basis points at 3.92%. 2-year also down 3 basis points, 4.78%. We have the inversion now, 86 basis points, moving up toward 100. This is a real indicator, guys. Recession coming. Now we know that an inverted yield curve is not a 100% accurate predictor of recession. At the same time, we know that every recession since 1950 has had an inverted yield curve preceding it. So I would say the chances are likely there's going to be this recession this year. It has to happen, man. Consumers are not going to just keep charging higher price stuff on their credit cards and paying higher rates on that credit card forever. They're just not going to do that. And sooner or later, the pandemic savings is going to run out. This market's going to run out of steam. It's not looking good. Dollar today down about 0.5 point, 104.67 on the index. Not a lot of news, still hanging tough. With the dollar down, metals ended mixed today. Gold gaining $5.70 an ounce to $1,816, a little more. Silver actually down today 17 cents, $20.59 per ounce. I'm surprised. I really thought silver was going to be a mover, especially with the way it's priced right now. It's reasonably priced for sure. I think metals really want to rally, guys. As soon as they get a reason to do it, they're going to take off. Oil today, not much news. Still in its trough there, down 63 cents, $75.80 or $75.69 per barrel for West Texas Intermediate. Just a nothing burger in oil today. Bitcoin down $284, 23,328. Another, again, not a lot of news in Bitcoin, price holding stable. News you guys need today, there's just a couple of little things to go over. First, I want to mention that U.S. equity funds, okay, so this is mutual funds that invest in the stock market, had their biggest outflow last week since January, $6.88 billion withdrawn from equity funds. Now, what happens, guys, when people are pulling money out of these mutual funds, that puts a lot of pressure on the stock market because these fund managers, to hand over cash for these withdrawals, have to sell stock. Puts additional pressure on the market. So when you see these big outflows, hopefully that's not going to be a recurring thing, right? But I got to say, guys, what a difference a day makes, right? Remember last week, early in the week, investors were really believing that there was going to be this Fed pivot later this year, that after this increase coming here next couple of days, I think sometime this week, there was going to be a long pause. We're going to digest where these higher rates have taken the economy, and probably rate cuts later this year with the recession. I got to tell you, man, I just don't see that, and I have not seen it. I've been telling you guys, of course. But people really believe that the pivot was a lock and a pause was a certainty. Well, how quickly things have changed, right? Now the consensus on the street is basically calling for a half-point increase coming up here at this next FOMAC, rather than a quarter-point increase. This just started happening late last week. Now it's kind of the consensus that this is going to be what goes down. The pause, we can pretty much throw that out the window. That's not going to happen. Now they're talking about quarter-point increases continuing for the rest of the year. Well, we know the terminal rate. They wanted it to be above 5. I was telling you it would be 5.10. Now it looks like it's 5.60. I got a feeling it might creep up again, guys. I think we could see over 6%. I told you guys there was going to be a surprise to the upside with that CPE last week. Inflation's not going away. It's just not going away. Now, some of you guys might remember your host saying inflation's going to be tough. In the 70s and 80s, it took them 10 years to get rid of it. The idea that we can do this in 6 to 12 months was ridiculous to begin with. Well, I was listening to Peter Schiff's podcast over the weekend. He's a guy I like. I think he's interesting. And he pointed out on his podcast that the Federal Reserve has only hit that 2% inflation target 11 times since 1970. So in 52 years, the Fed has hit that target 11 times. 8 of those times coming since 2010. So this low inflation is a recent phenomenon after the Great Recession. I think we're moving back into a more expensive money era. I think that, if you take out those 8 years, okay, let's say from 1970 to 2010, over a 40-year period, the Fed hit its target 3 times in 40 years. So I'm thinking, like I was saying in a podcast or in one of our shows last week, more likely the Fed's going to change its target than get to 2%. It's just crazy, guys. Crazy stuff going on. The Fed wants to mislead us and make everybody believe that this is just going to be a straightforward thing. They know exactly what to do. And, if they apply these certain principles, the results are guaranteed. Newsflash. Not so. Anyway, so it's going to be a fascinating week this week to see what comes. We know we got a ton of data coming. We'll go over that tomorrow. I didn't get that written up today. Before we close today, a couple of things really interesting to finish with. First, I was reading in the Wall Street Journal today. Department of Energy now believes that the COVID virus originated and came out of an accident in a Chinese lab. So remember when they talked about it was an escape from a Chinese lab, whether intentionally or unintentionally, and everybody was wigging out about it? And now you got the FBI and the Department of Energy saying that it came out of a lab. That just tells me that, confirms, I guess, that getting to the truth is really difficult. It's hard to find sources where you can find that truth. There's so much disinformation, bad information, speculation, masquerading as fact. Be very, very cautious, guys. These are unprecedented times, not only with our economy, the political situation here in the U.S., but geopolitically around the world. Everything is so very, very, very flimsy right now. This is a really good time to obey the rules we've been telling you. Let me give them to you again, just so everybody remembers. Number one, save as much of your paycheck as you possibly can. 10% is the target. 10% of your income goes and gets stashed in your FU account, just in case you ever had to tell anybody, FU. Secondly, invest that money very conservatively. This is not a time to try to make big gains. This is a time to preserve the principal, hold on to your hard-earned money, invest it. There's nothing wrong with investing it and trying to get a return. Just do it conservatively. Remember what my mentor taught me, guys. The definition of risk is probable loss. The rest of the principles we've been talking about are simple. Be a thoughtful spender. It's okay to spend money. Just be thoughtful the way you do it. Don't waste money. Try to stay away from impulse stuff where it's like, oh, I got to have this finally. Better to hold cash than have stuff right now, guys. Also, we've talked about try everything you can to not add on any new debt over this period, because debt's going to get more expensive. Also, if you have debt, do everything you can to chip away at it. Even if it's paying an extra $10 a month on your credit card, give up one of your cappuccinos, give up a lunch out with the guys or the girls, whatever. Pay a little bit down extra on your debt. Try to get that. The idea, guys, is very simple. We want to live in surplus. We need to discipline ourselves so that we can live within our budget, within our means. We can live on the money we make comfortably. We're actually saving money. We're in surplus. If you can get to that point, guys, you're already rich. Now, you may not be the classic definition of rich where you have bazillions of dollars in your bank account and you're earning interest and they're not taxing you on it. But you're rich because you have a surplus every month. You can continue to save your money. You can use that money to pay down debt if you have it. Building surplus is important. It's a lifestyle. Once you learn to live that lifestyle, you're going to be glad you did, guys. It takes a lot of pressure off of you. These are simple principles, the basics we've been teaching you guys since day one. Stick to those principles. You're going to be glad you did. We'll be back again tomorrow to give you guys all the news. Tomorrow I'll go over everything out of the journal today and let you guys know what data is coming this week, which days are going to be significant for the market, what we can expect. We really appreciate your guys' support. Back again tomorrow. Till then, guys, take care.